What's up guys? Today I will walk you guys through how to deploy your first $100 into a concentrate liquidity pools. And for this example, we're going to be using the pool first approach to find a crypto to crypto pool to get into. And those are pools like Solana to Ethereum, Wrap Bitcoin to Ethereum, or other altcoins like Arrow to ETH or Pendle to ETH. If you're new here, my name is Richard. I yield farm a lot of concentrated liquidity pools, and I've been able to generate consistent profits from it. If you guys look at my current open positions, I'm sitting at 5.36 Ethereum. And right now I'm running mostly altcoin pairs like Bonk to ETH, Arrow to ETH. And it's a great way to stack Ethereum profit and to accumulate crypto over time, especially when the crypto prices are cheap. And if you guys add my closed position, I am still sitting at an 8.61 Ethereum profit. So roughly 13 to 14 ETH of profit right now. And this number would fluctuate a lot depending on how the altcoin market is doing. So the goal of this video hopefully is to run through the process from beginning to finish. And I might skip over some details that are more time consuming, for example, the deeper research. And if you guys run through this whole process, you're going to have a better chance of making a profit comparing to not having a process in place to basically enter into a new pool. And before I dive in, none of this is financial advice. Please do your own research before making any investment decisions. So right off the bat here, if I want to look for a high APR pool, one of my favorite ways is to go to Gecko Terminal, especially if you don't know which tokens you want to provide liquidity for yet. So what I like to do right off the bat is click this filter button. And for minimum liquidity, I like to put at least 10,000. Sometimes there are blue chip pools with lower liquidity that has really high APR, so I don't want to miss that. And the fully diluted value, or this FDV, basically goes over like the valuation of the token, right? The bigger that number, the larger the market cap it is. And usually larger market cap tokens are less volatile compared to lower cap tokens. And they're also lower risk if they have a solid base of holders already. So what I like to do if I'm yield farming larger caps, for the FDV, I want to put at least 100 million. And for the max, I could set it to 1 billion if I'm only looking for that range, or I could just leave it open. And then volume, I want to set at least 30,000. And pool age, let's use 480 hours. And I could adjust these at any time, right? If I'm not pulling up the pools that I want to see, I could always go back and change it. So this pool age makes sure that I actually filter out like the newer pools that could have a lot of volume, but is simply too high of a risk, right? Sometimes like new meme tokens basically try to manipulate all these numbers to make it look like other people are buying it, but in reality, it's just a pump and dump. So I want to filter out by at least 480 hours. And after I hit save, I would have a new set of pools, right? And you guys could change between the FDV and the price if you like. And some tokens that I'm currently yield farming is doing quite well. For example, Arrow, in the past 24 hours, it went up by 17%, right? And if I move to the right, I could see the volume compared to its liquidity. So here I have a huge list of assets that I could basically filter out, right? And depending on what I'm bullish on, for example, if I believe that meme coin is going to come back in the next 6 to 12 months, then maybe I would go for a large cap play like Pepe if I want to play it safer, or something like Brett on base. That could also be one option, right? But if I'm sticking with more like utility projects that have like, some revenue and tokenomics to support it, then I could be looking for projects like Arrow, Virtual, and maybe even Kita. It's a newer blockchain. And basically we could just scroll down the list here. And most of these pools would have a good amount of volume. But what I could also do is double filter the volume. So right now it's sorting by trending 6 hours. I could switch it to trending 24 hours. And I could also double click this volume tab here. And when I do that, I'm going to pull up the highest volume pools. And I could see here, for example, Ethereum to USDC on base is pulling quite a lot of volume right now, sold to USDC. For this example, again, we're doing crypto to crypto pools. So if I want to do like a blue chip pair, I could basically do Wrap Bitcoin and ETH as well. Or I could do stuff like Arrow to USDC or radium to sol if I'm bullish on Solana. And basically I could just scroll down this list, right? And there's pools in Ethereum mainnet as well, like this Uniswap token or this Ondo token. But for this example, let's stick to a layer 2 or a low fee chain, because if we're just yield farming with $100, right, then it might not make sense to be on Ethereum mainnet where the gas cost might be a lot. So let's say I find a token that I like here. What I want to do now is to check on the charts. I could directly do that on Gecko Terminal, or I could basically do that on apps like TradingView. Let's say we were looking at virtual, right? I could pull up this virtual chart here and then see if it's bleeding out or if it's just performing really badly, right? I personally don't spend too much time basically looking into tokens that have been bleeding out when it should have been pumping, right? When the market was really bullish last year, if the tokens are really solid, then it should have been pumping as well. So let's say we look at this virtual token. You could see it had a huge run up last year from 2 cents all the way to pretty much $5, right? And then it dropped all the way to 40 cents. Now it's back above $1 and it's bouncing between this $1 to $3 mark right now. So pretty solid token. I could see that without having to do any research at all, right? The price action is really bullish. And if I look at the weekly chart here, you could see this huge run up last year, retraced quite a bit of its gain, and then it has recovered quite a bit as well. And right now it might look like the price is swinging back down, but overall this is still a strong chart. And what I could do is compare the relative strength as well, right? Let's say I want to compare virtual with smaller cap alts, then I could do virtuals divided by others here. So others are basically every altcoin that is excluding the top 10 altcoin. You can see it's pretty similar to the US dollar chart where virtuals outperform for quite a lot, retrace its gains, and then now it's consolidating up here. So from this technical analysis, I could say that it's something more like a flag and pennant, where possibly if it's basically grinding up here, it could push up once again if the market is really bullish or if virtual has another catalyst. So not bad at all. And if we go back to the normal virtual chart, I could also check its performance against Ethereum as well, because that's the token that I would be pairing virtual with if I'm trying to yield farm crypto to crypto pools, right? So here I could see again, virtual has pumped against Ethereum, almost back to its all-time high back in January in Ethereum terms. So this actually has been outperforming Ethereum for the last few weeks here. And maybe this would basically retrace its gains a little bit. And I could decide to enter like later if I want to, and just keep an eye on this chart while I do some research into the token, right? Let's say it retraced its gains all the way to its lows here. And if I'm still bullish on this project, I could enter into this pool as well. But let's just say I want to deploy right now. I could run through the simulation as well. So if you guys see this pool first process here, we basically did the first and the second part already. We found high APR pools, right? And then we checked the charts. And before I actually do deeper research, I might actually scan other virtual pools for a bit to make sure that the APR could be high. So what I want to do now is go back to Gecko Terminal. Let's say click on this virtual to ETH pool. And you can see this is Uniswap V2. So maybe the fee is not that high for a V2 pool. So I could try to look for a V3 pool here. Basically copy the contract address and paste it in the search bar. And I could see a bunch of different pools here. You can see here on Uniswap V3, there's quite a lot of volume compared to its liquidity. It's also on Aerodrome as well. So I could look into that. And there's some virtual to USDC pool as well, which is nice if I want to yield farm virtual with only USDC. So quite a lot of different pools to look at here. So let's take a look at this V3 pool first on Uniswap. I prefer Uniswap personally when it comes to providing liquidity, because a lot of people on Aerodrome actually squeeze their ranges a lot, which causes the APR to drop by quite a lot. So that's why I like to use Uniswap most of the time when it comes to providing liquidity. And to get the average volume, I could hit the setting button on this volume indicator here and then switch to style, tick on the volume moving average. And then if you go back to the inputs here, you can see this is based on the 20-day moving average. So I like to keep it at 20 days just so it's a little bit more sensitive than like other settings. And you can see based on this blue numbers here, the average volume for the last 20 days is roughly 13.946. So 13.946. And if we scroll down, what's the fee tier? It's a 0.05% fee tier. So the average volume is roughly 5 to 6x the current liquidity based on the 0.05% fee tier. So pretty great in my opinion, especially because the market has seen like pretty much lower volume compared to what we were seeing last year. So the APR for this pool is probably pretty decent. And to look further, I could use tools like Reverb Finance or Metrics Finance to basically find like the best pool to be in. And one way I like to do that is hit this filter tab. And let's say I put in Ethereum and then virtual here. So you can see if the token is not found, I could paste the contract address and it should be able to pull it up. I like to filter the age at least 30 to 60 days. Let's put 60 and then no withdrawal and in range only. And it's going to pull up like the best performing positions for these two tokens. So you can see most likely the best pools would be either on Aerodrome or on Uniswap. In this case, it's mainly on Base. But I can see right off the bat, there's two main pools that I need to analyze if I want to provide liquidity on Uniswap. The first one is this 0.3% fee tier pool. And then the second one is this 0.05% fee tier pool. So let me click into that, open a new tab. So this is the 0.3% fee tier pool. And if I want to look at some data here, sometimes for revert, the data doesn't really load, but that's okay. What I care most about is if I filter by age, I could look at the full range APR. And the reason why I like to use full range is because it's more consistent across different pools, right? Because all of these positions all have different range settings. So it's not really fair to like compare like different ranges, right? For example, compare this really wide range with this other range here, like between pools or within the same pools, then it's not really a fair comparison, right? So right off the bat, I could see over the last 200 days, if you had this full range pool, you will still pull a really good APR, roughly 30, 31%. So for a totally wide range, right? And if I scroll down here to something more recent, over the last 138 days, it has dropped slightly to roughly 26.5%. And if I go further down to a newer pool, last 53 days here, roughly 24, 25%. And the newest one in the last week, roughly 10%, because the APR might have dropped a little bit. So what I could expect is roughly 24 to 30% APR for a full range pool over a long enough time horizon. And if I look at this 0.05% fee tier pool over the last 161 days, you can see this APR is 24%. 117 days, APR is roughly 19%. And last 35 days, roughly 14%. So if I go back and look at this 0.3% fee tier one, I could see again over the last 52 days, the APR is higher at 24%, and the last 140 days, roughly 26.5%. Right? Compared to this lower fee tier one, roughly 160 days, 24% APR, roughly 117 days, 20% APR. So from this initial analysis, I could tell that this 0.3% fee tier is probably the best pool to be in. And so now what I want to do is simulate like the worst and the best case scenario. So what I want to do is I pull up this Desmos impermanent loss calculator, and I could change this value deposit here to 1. If I'm, let's say, yield farming with 1 ETH, and to show like an easier number, I'm going to start off with 1. And then you guys could edit like whatever amount that you're actually putting into the pool later on, right? And don't just copy like what I'm doing here. Make sure you're running through your own simulation, do your own research, pick your own tokens that you're actually bullish on, right? Don't just yield farm virtual because I'm featuring virtual here in this video. And I'm not even in this pool myself right now, right? Because I'm still waiting for an entry. I'm still building some extra capital that I could deploy if I want to yield farm this pair. And I still gotta do more research myself on virtual as well before I decide to basically invest. So don't just copy everything, right? So before I set like these parameters here, I want to hop back to the virtual to Ethereum chart and then see where I would set my potential range. So right off the bat, I want to set my range based on the weekly chart. So what I could do is set like the top and the bottom range with orange lines here, and you guys could use whatever color you like. But I could see that clearly based on the weekly chart, it seems like this previous area of resistance back here before this huge move up actually became an area of support, right? So maybe my bottom range could be right here or slightly lower here at this 0.0002 mark. And then the top range could either be at the previous range, or if I really want to go long on virtuals, I could set like the upper range to be all the way at infinity. If I care more about capital appreciation, I could do that. But if I want to optimize for fees, I want to aim for a range that I would basically be able to capture for the next 6 to 12 months. So if I'm bullish on this token, let's say I believe that it's going to basically reach like this 0.0025 mark, I could set my upper range here. And you can see this range is quite wide, right? It's not something that a lot of other yield farmers use. I personally prefer wide ranges because it's much easier to beat impermanent loss and to make much more profits from capital appreciation. And just as you guys saw earlier, even with a full range, you're still earning a nice 20 to 30% APR. So I could mark my entry here as well to make the calculation simpler. Let's just use 0.00066. And so I could hop back to this impermanent loss calculator. So price lower is at 0.0002, right? And then price upper is 0.0025. 2 zeros on the top and then 3 zeros on the bottom. And then price now, I could set it at 0.00066 because that's the price it's trading at right now. And then price deposit, I could deposit right now as well if I'm trying to yield farm right now. So the first thing I could look at is like the potential profit and loss, as well as the impermanent loss that I could be suffering. So if I click on this orange dot line here, if virtual's price drops all the way to my lower bound, my 1 Ethereum LP value is going to drop all the way to 0.42. And then at the top of the range, my LP value would bump up to 1.49. So not a horrible like risk to reward, especially if I don't expect the price to drop all the way to 0.0002, right? If you guys look at the virtual's price, maybe the bottom could be closer to 0.0025. So I could simulate that as well by changing this price now number to 0.00025. And here you can see roughly a 48% loss if that happens, right? In the worst case scenario, if that's a risk I'm willing to take, then I could potentially get into this pool. So that's the first thing you guys want to do is look at like the worst case scenario as well as the potential reward that you're going to get. And maybe it doesn't seem like the potential reward is that great right now because it's not, right? Because the prices are not trading at this like very cheap area any longer. But if you're still comfortable with taking that risk, then we could still hop into this pool. You can see if the price reaches down there, I would suffer a 23.4% impermanent loss. And if the price pumps to its previous all-time high, for example, at 0.0015, I could simulate that as well by changing this price now there. You can see I would suffer only a 16.6% impermanent loss. And impermanent loss is basically your LP value compared to your HODL amount. Because if you're in the LP, whatever virtual that you would have is being slowly sold into Ethereum, right? So you are losing a little bit of virtual on the way up. And compared to holding, you would have less Ethereum value if you held separately. Because again, you're selling your virtual on the way up. And at this upper price point, your virtual is going to be worth more Ethereum, right? But in theory, if the APR is, let's say, 50%, and you stay in range for like 6 months, then you're basically gaining a return of 25%, right? If that 25% is greater than this impermanent loss number, then in that case, you would be beating just holding these two tokens separately. So that's the thing to understand about impermanent loss. If your APR is greater than this impermanent loss number and you stay in range for a long time, then you would be just simply holding in the market. And before we run the simulation further, let's say like we change the price now back to where it was, right? The risk and reward is not that great But what I want to show you guys is, let's say you had a better entry. Let's say virtual's price like continues to retrace and is sitting in an area of support, right? Let's say you enter at 0.0003. So not even at the Pico bottom, right? We could run the simulation with the same parameters. So let's say you enter at 0.0003 and then price deposit also 0.0003. We're entering with the same one Ethereum, right? But maybe if the prices are trading there, you might want to have a wider, like lower range. So maybe 175 here. And let's say we keep like the same upper range. This is like a bullish LP because we have roughly 73.4% worth of virtual at this price deposit here. And you can see that by this X ratio here, which is this orange area as well. And you can see as the price pumps, right, our virtual is going to be slowly sold into Ethereum. So what I want to do now is run the same simulation. Let's say the price now pumps to its previous all-time high, right, at 0.0015. You could see my 1 Ethereum would appreciate to almost 2.22 Ethereum. Compared to its lower bound, if the price retrace, I would end up with 0.63 Ethereum. And you can see the risk and reward is much greater here. I'm risking less than like a 50% drawdown to gain like a 2x, right? So this is why, like, if you guys enter the pools at a really good price, your chance of making a good profit is much higher compared to, entering at the top of the range and basically try to dig yourself out of it. So that's another thing to basically understand when you guys are yield farming crypto to crypto pools. So let's go back to our previous settings, 0.0066, 0.0066, with the bottom range at 0.00002. So what I would typically do if I'm basically yield farming this pair, I would backtest the APR with revert by clicking this create position here. But a lot of times the data on base doesn't work on revert. So what I could do is copy the pool address and go to apps like Metrics Finance Pro and basically try to get an APR estimate there. I'm going to show you guys the free version because you really don't need the paid version. But if you can afford it, you could go for the paid version as well. Let's say I put Ethereum here and then virtual. And you guys could run through like simulations for 0.05% or this 0.3%, right? I would use 0.3% for this example because we saw that, the historical APR is higher on that pool. And here I could estimate my APR. So I want to change this quote asset to Ethereum here. And for the free version, you could see the volume data based on the last 30 days. And if I tick on this full range here, you can see the APR is roughly 18.56% based on the last 30 days. So not that far off from the revert finance data that we were looking at, right? Maybe over a longer period of time when the prices are doing well, the APR would be probably greater than this 18.56%. And what I want to do now is change the minimum price and the maximum price to the range I had, so 0.0002 and then 0.0025. So with this amount of concentration in the LP, if you see this pink or reddish line here, you can see my APR would be close to 40%. And in reality, it's probably greater than that if the pair is very volatile, which it is in this virtual to ETH pool here. If we go back to the chart, you can see that the price went all the way to 0.0011, right? And in the last few weeks, it basically was trading near like 0.003 and 0.0004. So really the price fluctuates like all the way from these like low area of concentration all the way to this upper area here. So my average APR is probably greater than this 40%. But if you guys are happy with that 40% APR, then this is a great pool to get into. And again, like I explained, right, if the price went up to its previous all-time high, and based on this conservative estimate of 40% APR, I would beat this 16.6% very comfortably, especially if I'm in range for at least 6 to 12 months. And with a wide range strategy, typically you're not just trying to get in and out. Like it's not going to be something that you're yield farming for the next 1 to 2 weeks, right? When I yield farm, I always pick pairs that I want to be in for a minimum of 6 to 12 months. That's why if you guys look at my wallets, you're going to be able to see that I beat impermanent loss very easily here because again, I suffer very little apparent loss because of a wider range. I generate a high amount of APR because I get into the best pools, and then I stay in range for a very long time to make sure that I'm actually accumulating and taking profits and beating holding in the market. And the last step after you guys simulate is simply to deploy this capital. So let's go back to this entry. What I want to do now is swap whatever Ethereum I have into this amount of virtual token, right? So to get that number, simply take whatever Ethereum you're investing in and then multiply that by this X number. So let's say I invest 1 Ethereum. I want to figure out how much I need to swap. Then I multiply that by 0.519. So this is the Ethereum amount that I would need to swap into virtual to basically deposit into the pool, right? And let's use an example of $100 just so that everyone could basically test out the water, right? This video is mainly made for like people who are new to yield farming. If you guys have at least $100, you could test out the waters by using that $100, right? And then scale up from there, or whatever amount that you could afford to lose. Because if you make mistakes, that's the best way to learn, right? You don't want to put your whole portfolio into like different liquidity pools and then make a ton of painful lessons. You're losing, thousands of dollars that you basically have to take a long time to make back, right? So that's why we're using $100. And to basically price $100 in Ethereum terms, I'm going to take 100 divide by 2516 is the current Ethereum price. So this is the amount of Ethereum you're putting into the pool, 0.039745. So I could put that here. Let's say it's 0.03974. And then I'm going to do the same thing, right? 0.03974, multiply that by 0.519. This is the amount of virtual token that I need to buy, 0.0206 Ethereum. So what I want to do now is go on a platform like Llama Swap to basically get like the best swap price to swap my Ethereum for virtual. And Llama Swap is a DEX aggregator, meaning that it's basically trying to find like the best exchange rate for you when you're trying to swap for a token. So I'm going to buy this amount of virtual token if I'm actually getting into this pool, right? So you would be buying this 31.175 virtual token in this case. And Llama Swap doesn't charge you any fees. And usually these swapping front ends, they don't charge you a fee as well. If you guys go to Uniswap and swap, they charge you like a 0.25% fee. And it's not a lot if you guys use just $100. But if you're playing with tens and thousands of dollars, then those fees could add up. So what I want to do now is basically go to Uniswap and deposit into the pool. I could go to this pool section and then create position. And then I want to make sure that I'm on base, Ethereum, and then virtuals here. I use V3 because a lot of tools still only supports V3. And there's more liquidity there. Usually the APR is higher right now. And it auto selects this 0.3% fee tier, which is a better pool based on our simulation. I'm going to hit custom range and then put this minimum price here, 0.00025, max price at 0.002. And then I'm going to put the deposit token, right? So in this case, I would have been able to swap roughly 31 virtuals. So I'm going to put that 31 virtuals. And if you guys total these numbers up, you could see that it's close to $100. So that's how you basically deploy the pool. And once you guys are happy with that, then you could deposit the tokens directly into Uniswap. So I just took you guys through like the whole process here, right? We're scanning for the pools, right? We found the high APR pool. We look at the charts. We did deeper research. We also found the best pools for virtual and Ethereum. And then after that, we went through the simulation, right? We looked at the chart. We set the ranges. We figured out our APR. We calculated our impermanent loss. We did a risk and reward analysis if it's worth it or not. And then if we decide to deploy, then we're swapping the needed tokens, deposit the tokens into the pool. And then if you want more security, you could basically move your LP into a vault and then update whatever tracker that you're using. So that's pretty much the whole process of deploying a crypto to crypto pool. It's been one of the most consistent way for me to accumulate more crypto and basically make a large amount of profits over time as I keep yield farming. There's typically much less impermanent loss compared to crypto to stable pools, but at the same time, you could be suffering a little bit of a sharper drawdown if these underlying tokens don't do well. For example, if virtual doesn't do well, then my LP wouldn't do well as well, right? So if you guys want to learn more about yield farming, be sure to check out my other videos, especially this how to deploy your first $100 into a concentrated LP one. This one goes over Ethereum to USDC, so a crypto to stable pool rather than a crypto to crypto pools. I try my best in these videos to give you like the best information so that you could be more consistently profitable. Thanks for watching. I'll catch you guys next time.